Hi everyone and good afternoon. This is Michelle Schneider, Mish, talking to you from Santa Fe, New Mexico. It is post the FOMC minutes here and we're getting kind of a muted reaction, but my goal for you today is to take you through some of the indices, the reaction, the inflation expectation, and just generally what we see for the markets now in the next few days. What we're looking at right here is a chart of our big view, a recent gauge's value. And what's interesting about it is that you can see that red is bearish, orange is neutral, and green is bullish. And up to a week ago, we were 100% bullish in terms of sentiment on risk. And now here we are 1 week later and we are neutral. A month ago, we were also neutral, but we were leaning closer to the bearish stage. So neutral almost seems incredibly aligned with what the market is telling us, because as we've been talking about over and over and over again, is that the SPY in particular is stuck in a trading range. All of the sectors, at least the key sectors, went up to a 23-month moving average, which also represents a 2-year business cycle. Significant, because in 2021, obviously we had a big bullish phase, 2022 a big bearish phase, and 2023, we really don't know at this point what's in store for the markets and for the US economy. One thing we know for sure is that we've seen massive inflation, particularly in the food areas, and we have still Dr. Copper hanging tough and steel hanging tough, but energy and oil has been the laggard, which is why many believe that the policy of the Fed is working to a soft landing, while others say no landing, while others say hard landing, and some say it's a modified version of stagflation. So let's hope the charts can help us sort it all out. Probably the most efficient way to gauge whether or not we're heading more into an inflation narrative is by checking out the price of gold. And we know that we had a huge rally in the gold starting from November 2022 all the way until pretty much recently. That would be the beginning of February, when we finally had this gap lower, and now we've been trending lower. So if you look strictly at the charts here, this is a daily chart, one can say that inflation, even after the hotter PPI and CPI that we had recently, has cooled. And as much as I have been in the inflation camp and as much as I've been bearish gold, one thing I have learned over my many years of trading is that price rules. And so I would be more than willing on a dime to say that at this point, what we're seeing here is more fear in the market than anything else, that not only inflation may necessarily be the biggest factor going forward, but that because the yields have gone up and because the Fed funds are where they are, we're actually seeing the opposite camp, which is now looking more like recessionary deflation. Now, of course, we're still holding a lot of support, so we can't make that conclusion yet, but it is very interesting, and especially I, of all people, who have been so strongly bullish about gold and the fact that we could go to this hyperinflation. Again, opinion is one thing and trading strategies is something else. Of course, we have a lot of geopolitical risk out there, any of which could spark another rise in gold and in inflation, obviously with food shortages, with China and Russia, with the United States spending a ton of money in Ukraine, with Putin sort of waving the war story, China and the threat to Taiwan. Any of these could really wind up being a problem, along with BRICS, along with debt, high debt of government sovereigns. So it is really, really a very dicey situation right now. So I wouldn't necessarily get married to one narrative or another, but I would certainly keep an open mind. So now we have been long gold, we at MarketGauge have been long gold really since here. And we've taken profits along the way, so we're holding a core position. And you could see why we would have been tempted to potentially add, but until it gets back over this 50-day moving average, right now we're in what we call a caution phase, with obviously looking at the 200-day moving average now as the next major support. It's underperforming the SPY, and our momentum, after a nice little mean reversion that we had in here, is now breaking down under the 50-day moving average. So we are no divergence in terms of momentum and price. Both are declining sharply, and I think it would be interesting to look at a weekly chart, because the weekly chart looks a little bit better, but that 165 level, really in this case it's 167, so figure 165 to 167 corresponds with a longer time frame as far as support. We can see on the weekly basis we're doing better against the benchmark. And again, in terms of momentum, what is interesting is where we had a golden cross way back here, where the 50's over the 200. On the momentum indicator, we actually had a death cross, a mean reversion to the downside down here, and we haven't quite figured out whether or not we want to get back over the 50. So here's your real divergent. Momentum down, price more on support, and really at this point now, like I said, gold could continue to go lower from here. I wouldn't discount that possibility, but it could also, any of the incidences that we're talking about geopolitically can drive this up. And that's how precarious it is. So in terms of the question of inflation, we really need to be looking more at the food inflation. NDBA on a weekly chart got right up to the 50-week, as you can see here, and on the daily chart took out the 200-day moving average, well outperforming and above the Bollinger Band. So I would say that before I made any great decision on the whole idea of inflation or not, rather than watch gold, and certainly rather than watch oil, which looks very heavy right now, keep your eye more on the food. And if DBA starts to break down back under this 2040 level, and this is all your ags are in here right now, and there's an interest rate component to this as well, and we start to see this match more in line with the SPY performance, and particularly if we get yet another mean reversion where it breaks down in our real motion indicator under the Bollinger Band, then yeah, maybe we're going to be singing a whole different tune. But that's how precarious we are right now. Now let's go over to the indices here. With the S&P 500, this is a daily chart. Again, looks kind of similar, except a little bit stronger than gold, and you can see why here, because it's holding above the 50-day moving average, and you did have the golden cross. So at this point right now, this has been a correction to support. So 390 is really our big area. That's actually all the way down here under the moving averages, and you'll see why when we look at a weekly chart. We said that 4,200 was going to be the top, 4,100 was going to be pivotal, 3,900 is our next major support, and if that breaks, although we could get some work here at the lows that we had back in December around 3,700, we believe that this can break down, even take out 3,500 and go down to 3,200. And that would not necessarily be because of rising inflation. That would be because the economy just cannot get going, and all of these warnings that we keep seeing economically start to take hold. And of course that could lead to a Fed pause or a pivot, in which case that could turn everything around, but particularly put us back into an inflationary cycle. And if this sounds kind of like talking in circles, really that's kind of what the market is doing right now. It's moving in circles. And the momentum indicator here on the SPY is also in a bullish phase and getting closer to support. So that's how close we are. Does gold break down? Does gold hold? Does the SPY break down further? Does it hold? These are going to be the big questions. Can the food commodities ease up a little bit? Right now, one of the biggest factors we have is actually in coffee. And looking at the coffee chart, we can see that this is JO. This is actually the ETF. Bloomberg Coffee ETF, which has cleared the 200-day moving average, is gaining in terms of its traction against the benchmark and in momentum, which really is just one of the factors of the whole DBA ETF, which has also been moving, and cane, which we're going to use to represent sugar futures, also, although running into big resistance, has had this huge move up as well. Interesting that it had a mean reversion down here. Turned out not to be so good. And now here we are just sort of sideways. So both of these areas have to be watched. And of course DBA, which is the ultimate ETF, has to be watched as well, because you can see that that too made a big gap up coming into this week. Now it could be leaving some kind of an exhaustion top. Again, goes back to the precarious nature of how everything looks. Now, since we had this big rally coming into this past week, it was a lot led by growth stocks and by NASDAQ stocks, and we have most of the earnings out of the way in terms of the big growth stocks. NVIDIA actually is going to report after the close today. But what you can see here with NASDAQ as we're looking at a daily chart is that we have not had the 50 clear over the 200, so this is still in an accumulation phase. It's actually still slightly outperforming the SPY, but the momentum has come off a lot along with price, no divergence. So I think another key to the puzzle for you all to be watching, besides what happens with food commodities, with the SPY holding support, and obviously with gold right now, is what's going to happen here when it comes to the NASDAQ, because if there's any sense that the Fed will hold off, and with GDP tomorrow, the expectations are 0.6% growth, which was more than the 0.2% growth originally thought, but because of some of the recent ISM numbers, people feel that the economy is doing better. Well, if that's the case, again, we'll have to wait for the next numbers in labor, but with the jobs strong, wages going up but not by too much, consumer debt rising but yet retail sales strong, and sort of a thrust back into tech here, especially since AI has become all the buzz, SPY would have to hold, but Qs could be really the place that winds up doing better. And again, at this point, just to put some numbers on it, you got to hold around the 290 level, and I would say clear back over 300. Now, also we want to take a look at the dollar, and again, with this particular stock charts, you're looking sometimes at the ETFs makes more sense. So obviously you can see the dollar has also cleared back over the 50-day moving average after holding its big decline, but it hasn't quite really wowed us yet. It would need to clear. I'd say this probably looks more like 106 if you're looking at the actual dollar. Here it's 28.50. And you can see it's back to outperforming, and momentum is just now starting to catch up. So again, this will be a big factor, because if it goes up too much, that's not going to be good for the markets. It certainly won't be good for the gold markets right here without fresh information. And yet on the other hand is if gold or silver or even the food commodities hold, or in the food commodities case continue to go up in the face of a stronger dollar, and with yields now higher, although a little bit off its absolute highs this week after Fed meeting, then the dollar could actually get stronger, and in which case most likely you might see a more of a flow out of the equities market, out of the commodities market, and more into the fixed income market. So really, this is, again, so inconclusive that this is probably a good time to be a little bit patient, maybe raise a little cash here, look at the fixed income market, and if you're into more of an active trading mindset, I would say, if anything, our risk more is to the off than to the on at this point, given everything I just told you, and I certainly wouldn't be necessarily looking for any safety in gold, except of course if we wind up with some kind of a horrible geopolitical situation. Now, in the energy market, today was a very pivotal day for natural gas. Natural gas actually got to a point, and you don't have volume indicators on here, but it had two huge volume days as it looked like it was starting to have a blow-off bottom. And actually I tweeted, and that's at Market Minute, that it looked like there was a bottoming type of formation, at least for a day trade. And so far that looked like being the case. It topped out today at 8, which is exactly where all these lows were before it broke down. So you literally had a move from 740 to 8, and that's about it. You could have risked to yesterday's low, which would have been under 714, let's say, or 720, and you would have had 2-to-1 risk reward on a day trade and probably be out of it at the end of the day. But in order for this to be a real reversal, first of all, we'd want to see a close above 746. This is actually an inverted hammer doji, which could mean a reversal to continue to the upside, because it looks like sellers are being forced into it here after the market is selling off. But on the other hand, like I said, I'd watch this 746. If this closes above it, It's possible that if we get through 8, we'll see another leg up, maybe back up to 10. Would that really change the narrative for energy? Probably not, because the oil market is under pressure here, a lot of pressure, but it could switch the focus from the oversupply that we've had in natural gas to now some other fundamental issue which has not emerged yet, but are at least some kind of a technical bottom for trading the natural gas as opposed to the oil, which now looks like it's much toppier. So in conclusion, I think that essentially we have to really be looking at this market, and let's go back to my favorite index, which is the Russell 2000, very US centric. We're in a trading range. 202 would have been the 23-month move here, didn't quite get there. That was also the August high. We got close enough, it's coming off. It looks very similar to what I just showed you in the SPY and in the Qs, coming closer to support. But I think right now, with the momentum going down, as I said, to me it seems more downside than upside, but at the same token, that doesn't necessarily mean that we're going to crash. It could mean that next test would be 180, we could chop around. And what would make this market go back up? There's only really one thing at this point, and that would have to be at the next Fed meeting, which we will have in March, more conversation about a pause as opposed to what we're hearing now, which is a consensus of another 0.5% raise as inflation numbers haven't cooled off enough and the economy is still hanging out. Last thing to show you is the difference between this and the emerging markets. Because of the strong dollar, we are now getting pressure in the emerging markets. So the US markets that I showed you were above the 50. In the emerging markets, you can see broke the 50 and are down below the 200. This is also not a very good sign, because if we get into a strong dollar and any kind of energy crisis or any reasons why the European markets can continue to fight their inflation, which remains persistently high, continue to be aggressive more hawkish here, this could really be a catalyst for not only driving the US market down, but for that harder landing that some people expect. Let's just say in all the years I have been trading and watching the markets, this is probably one of the most uncertain times that I can remember where I could literally make a case that we come in and we hold here, or that we can go much lower. One thing I know for sure is that these levels that I've shown you today are not going to last very much longer. So that's it for now. Please find me at Market Minute on Twitter, MarketGauge.com, our website. Look for my daily that I write this type of information every day and give you actionable information to look at. And if you haven't already, check out my 2023 Outlook. Thanks so much for watching, and bye for now.